Welcome to another episode of Good Value by Antipodes.
Just 2 years ago, we were talking about negative oil prices and collapsing energy markets during the onset of the first wave of COVID-19. Since then, a lot has changed. From the global energy crunch that we discussed on this podcast in November last year to now, the devastating crisis in Ukraine.
Today, I'm announcing the United States is targeting the main artery of Russia's economy. We're banning all imports of Russian oil and gas and energy. That means Russian oil will no longer be acceptable at U.S. ports, and the American people will deal another powerful blow to Putin's war machine.
With the breakout of war, the fragility of global commodity markets has been laid bare. It's Alison Savvis with you once again. For this episode, I'm joined by Antipodes Portfolio Manager of Hardware, Industrials and Commodities, Graham Hay, to discuss energy and commodity markets amid the current global uncertainty. How are you, Graham?
I'm very well, Alison. Good to be here.
Graham, let's first talk about how we've been thinking about energy markets over the past few years. The Antipodes global portfolios have been overweight energy for the last 6 to 12 months, led by exposure to US oil and natural gas producers. And this has been a key contributor to alpha during recent market volatility.
That's right. As you know, we had been building energy exposure going back a couple of years now. The genesis of that thinking was really the observation around the broader capital cycle that was likely to play out in oil and gas. And it's an industry, of course, that is very capital intensive. And if you look at the pace of CapEx since its peak in 2014, by the end of 2020, we were looking at an industry that had dramatically underinvested in growing its production. And there's a few reasons for that, which we can go into, but the inevitable consequence of that was that we would likely see a price cycle, in other words, rising energy prices. The rationale behind it, how did we get to that position? It was a combination of factors, really. The industry, sort of by the end of 2020, was in a pretty dire situation. There was enormous balance sheet leverage. The track record of the prior 5 to 7 years of returns was pretty bad. We had a reconstitution of the shareholder base that was insisting on a very different capital program amongst listed companies, one that would prioritize debt reduction and the payment of dividends over growth. And at the same time, we had the rise of ESG overlays that were running the ruler over everything that the fossil fuel industry was doing. All of those things really have conspired to raise the hurdle rates that are required for oil and gas companies to invest in new capacity. And indeed, you've seen the industry spend at really only maintenance levels of CapEx for the last couple of years. And whilst that sounds adequate in itself, maintenance CapEx is really only the level of spend that gets you to declines in oil production rather than increases. And there are various scenarios out there as to when fossil fuel demand will peak. But in our analysis, we see demand still rising until the latter part of this decade. And there is a requirement to grow production to support that. The outcome of that, of course, is we've now seen a very significant price cycle. Oil prices have moved up dramatically in the last year. And of course, the conflict that's now underway in the Ukraine, which you mentioned, has only added fuel to the fire, given the importance that Russia plays in the global energy system.
And Russia really does have such an important role in energy markets globally, but particularly so in Europe, doesn't it?
Yeah, that's right. I mean, Europe is very much dependent on Russia for a significant part of its, particularly its natural gas supply. Europe, just to give you some round numbers, consumes about 500 BCM of natural gas a year. About 150 billion of that BCM of that comes from piped gas from Russia, and then another portion on top of that from liquefied natural gas, LNG. So Russia is very important, and there are certain countries where Russia provides as much as 75 to 100% of gas supplies for certain countries within the EU, mainly those in Eastern Europe. So it's a critical source of supply, and has given the conflict that's now underway, it's become certainly a bargaining chip between the EU and Russia. So we sort of need to be very conscious of the potential fallout effects of any change in policy on either side of the fence here.
And do you think Russia will turn off the gas to Europe?
Well, that's a question that everyone's asking. Of course, there's been sort of various statements made around that possible scenario. It's worth pointing out that Europe, in the immediate days and weeks after the conflict was initiated, have, I think, taken stock of the fragility of their energy security and have announced a range of measures that will see them accelerate their move away from their dependence on Russian gas. And in the last week or so, we've seen a legislative proposal from the EU that would require the bloc to have their gas storage at a minimum level of 80% at the start of next winter, so around October this year, and then rising to 90% in the years after that. So that is, their ability to do that is very much dependent on having access to Russian gas. It's simply not possible between now and October of 2022 that they could seek alternative means of restoring their gas levels to those levels. So I think all scenarios are being sort of countenanced, no doubt, and we've seen LNG supplies into Europe tick up quite strongly in the first 2 months of 2022, and that can continue, but there is a limited capacity for LNG to supply Europe in the short term. They very much depend on Russian gas. So nobody, of course, knows the answer to your question, Alison, but it's something that it's occupying everyone's mind as we speak.
And Graham, it's not just energy prices that have moved due to the crisis in the Ukraine. Commodity prices broadly are rising. Russia, Ukraine and Belarus are not only large exporters of energy, but are also important suppliers of several commodities. So can you take us through the wider implications of sanctions against Russia and the impact to Ukraine?
Yeah, that's right. I mean, Russia and the Ukraine and Belarus combined are very important export markets for a range of commodities, not just oil and gas. We see things like aluminium, nickel, steel, fertilizers, sunflower oil, various grains, for example. All of these markets are potentially going to be impacted by the sanctions and inability to get this product to its intended export destinations. We have seen, for instance, a significant move up in palm oil prices. Palm oil is a product that competes with sunflower oil. Sunflower oil, about 50% of world production comes out of that part of the world and is likely to be impacted. And so we've already seen flow-on effects in the price of palm oil over the last several weeks. We've seen also significant increases in the price of potash, where Belarus is a major exporter of potash. There were already export restrictions that were in place ahead of this conflict, but the inability to transport those tons through Russia has made it almost impossible for that product to reach market. So there are some wide-scale effects here that are playing out and will be felt through a number of product and commodity markets in the months ahead. So all the attention, of course, has been on oil and gas, but we see a much broader impact across a range of commodity markets this year.
Can we go back to that original thesis and why we have been overweight energy before the current price surges and talk about our longer-term view of the energy market? So looking beyond what we're all hoping for, which is, of course, a peaceful end to the conflict in Ukraine, natural gas in particular is an area we've been positive on even as the world decarbonises.
That's right. So it's worth mentioning that we have long held the view that natural gas is an important stepping stone or transition fuel in the path to a decarbonised economy. The reality is, for large parts of the world, the ability for renewables to provide baseload power that is consistent and reliable simply today does not exist. And there are lots of countries that want to get off the use of coal and see gas as a mature, stable, much lower carbon emission option in order to do that. So I think you're seeing growing recognition of that across a number of political parts of the world, and there's even consideration in the EU of including gas in the EU taxonomy. So, I think it clearly has an important role to play. And we, through the portfolios, we've expressed that through some very specific exposures in the US, where we see a combination of very well-run companies with high-quality assets producing a product which is trading at a very significant discount to the world price. In other words, US natural gas prices, as measured or expressed by the Henry Hub, trade at very significant discounts to the prices that are paid in Asia and in Europe increasingly. Now, the reason for that, of course, is that US gas has historically been largely trapped inside that country without a meaningful way of getting to market. But as the investments in liquefaction capacity in the US begin to pick up, and that's certainly the case as we speak. We're seeing a lot of new capacity come to market. We do see a path for a recalibration of US gas prices to take advantage of the very strong prices in other parts of the world. And so from a portfolio perspective, the way we've wanted to play that is to own high quality businesses that have low cost and deep inventories of natural gas. Importantly, in parts of the US that have access to that LNG capacity, and so we've built various exposures. Exxon gave us certainly access to that, and more than half of their upstream portfolio is natural gas, and a good portion of that is onshore in the US. They have other complementary natural gas assets as well, but that was a key part of the thesis in owning Exxon from the start of 2021. But we've also complemented that with other positions. A company, for example, such as Coterra Energy, is a largely pure play gas company without any offshore assets, and it also uniquely in the US oil and gas industry, it had a largely unhedged production profile. One of the kind of consequences of the malinvestment that happened across the industry was that all of the financiers were insistent that oil and gas companies hedged their price exposure so as to guarantee a minimum level of interest cover on their debt. Coterra had the unique position of being unlevered and had the ability to run an unhedged production profile. So in buying Coterra, you get all of the upside to the move in prices that we've enjoyed over the last sort of year and a half. So those two names together have been sort of cornerstone positions for us over the last year or so, and have certainly performed very well. And as we look at them today, with the stocks having sort of done quite well, at spot sort of commodity prices, natural gas and oil, both stocks are still very attractive on a free cash flow basis. Coterra trading close to 20% free cash flow yield. Exxon not quite as high as that, but certainly attractive at north of 10% free cash flow yield. But importantly, for Exxon investors, close to a 6% dividend yield. So, still very comfortable with those positions, and one might now consider the possibility of complementing them with other exposures that are part of the same ecosystem.
Okay, Graham, let's move on to the second part of this episode. You've mentioned both Exxon and Coterra, so can we spend a bit more time on our current portfolio positioning? In terms of energy production, the ultimate goal is decarbonisation, but this is a multi-decade investment cycle and there will be steps along the way. For example, you mentioned the role of gas as part of the transition. The Antipodes global portfolios have exposure to Technip Industries and Siemens Energy, which are both beneficiaries of decarbonisation. Can you take us through these holdings?
Sure. These sit very much complementary to our producer exposure that you just mentioned. Both Technip and Siemens Energy are geared to energy infrastructure spend. Technip Energies, for instance, in the 1960s was the very first company to develop an LNG facility. They have a more than 50-year history in developing, designing, and managing these types of installations, and continue to do so today. The company was recently spun off from a larger entity about 18 months ago, and like often happens with spin-offs, was left somewhat orphaned by investors, and we've seen that as an opportunity because when we look across the landscape around the amount of both greenfield LNG capacity that has to come online to move that US natural gas to other parts of the world, or we look at the remediation of existing facilities, both petrochemical, oil and gas, etc., the decarbonisation of existing facilities. Technip Energies has the engineering skill set and capabilities to really build and service those opportunities. So it's a company that we think is grossly underappreciated by the market. We are in the foothills of a major investment cycle across decarbonisation and rejuvenation of energy infrastructure, and that is evident in Technip Energies' backlog of business, which is a multiple of their current market cap, and certainly the recent reporting by the company indicates that that thesis that we have is coming through in their numbers. So we think it's a very interesting situation. The stock trades on a single-digit multiple of earnings. And whilst they do have some exposure to Russia in the short term that could impact numbers as we go into 2022 and 2023, the important point to make there, though, is that there is no balance sheet risk, because these types of projects where they're building large LNG trains for a customer, they receive all the cash up front, and then they draw down on that cash as they deliver the project to the client. So there's no material balance sheet risk associated with their Russian exposure, but there may be some earnings risk to come out. Having said that, the backlog is very diverse and continues to grow. And so looking beyond the short-term sort of hiccups that could happen relating to Russia, we see a business that has a very long runway for profitable growth. Siemens Energy is a slightly different story. The company, there's one similarity in that it was also a spin-off from its mothership Siemens, a company that we've been invested in for some years ourselves. Siemens Energy is a company whose business spans traditional oil and gas, gas turbines, I should say, transmission and distribution infrastructure. But they also have a stake in the world's largest offshore wind company, Siemens Gamesa. That stake is about 2/3 of the company today. The remainder is publicly listed. So we actually have a valuation for that unit to ascribe to Siemens Energy. When we do the analysis on ascribing that value, we see that Siemens Energy's core business trades on the paltry multiple of about 4x EBIT, which is and again, for a business that is growing its backlog and improving its profitability, is a very low multiple. The other thing that Siemens Energy has going for it, which is something we think will materialize commercially for them in the second half of this decade, is they have one of the most advanced electrolyzer ecosystems in the market. Electrolysis, of course, will play a very big role in the production of green hydrogen, and Siemens Energy, combined with their offshore wind capability and green hydrogen ecosystem, really have a complete solution for next generation energy systems. And again, we think that is heavily overlooked by the market. primarily because of the concerns that have emerged around the wind business in the short term. That sector, as you may have read, is dealing with rampant cost inflation, and the company are taking measures to try and stem the worst of that impact financially. But we think that is ultimately a transitory factor, that once that is under control, we think the market will start to look through the longer term growth opportunity that comes with it.
Nutrien is another another portfolio holding I wanted to discuss with you. We established a position in it last year. It's the world's largest potash producer, and potash is a key component of fertiliser. Nutrien is going to be impacted by the current crisis as the supply of potash from Russia and Belarus is taken out of the system due to sanctions, and you touched on this earlier. So can you take us through the Nutrien investment case?
Sure, Alison. As you say, Russia and Belarus are very important parts of the fertiliser ecosystem. About a third of global potash volumes come out of that part of the world. Sanctions had already been in place against Belarus, which limited their access to global markets. But the full-scale, situation in Ukraine and the inability for various logistics facilities to participate in Russian goods movements means that they are now pretty much officially locked out of the market, and that has served to dramatically tighten potash markets further. Now, of course, when we invested in Nutrien, we were not aware that this would happen, of course. As you mentioned, Nutrien is one of the very important players in the global fertilizer industry. Business is dominated by the production of potash, where they own and operate mines in Canada. They are one of the world's lowest cost producers. The cash costs per tonne run at about $6. Which puts them at the very low end of the cost curve. And they're responsible annually for about 15 to 16 million tonnes of potash production. They also have an interesting retail footprint that came about as a result of a merger some years ago with another Canadian company. And that retail footprint gives them direct access to the ultimate buyers of these products, that is the farming community. So that we think provides some interesting optionality around the core upstream commodity potash business. As you mentioned, it's a business that we got involved in last year, mainly because we saw that the agricultural cycle was quite well underwritten. The stock had performed quite well ahead of us purchasing the shares, but when we looked at the implied fade in earnings that was built into the forecast out over the next couple of years, and we modelled that against our own supply-demand estimates for potash in particular. It was very clear to us that the market was overly concerned with the down cycle happening, and of course, we weren't, of course, to be aware of what was to come in Ukraine, but again, that has highlighted just how fragile some of these commodity markets are, with Ukraine and Russia coming out of the system effectively.
And finally, I wanted to end with a quick discussion on gold. Costs are rising on so many fronts now, aren't they? And the situation in the Ukraine has arguably intensified that tail risk of stagflation. Stagflation is the combination of an economic growth disappointment and an inflation shock. And the longer the conflict continues, the greater the impact on economic activity, and high energy and commodity prices are adding to existing above-trend growth in wages and rent. And gold really is the ultimate inflation hedge, isn't it, Graham?
That's right. We've had a position in gold for most of the inception of the fund. In fact, we have increased that position in the second half of last year. It's a combination of factors. I think gold is unto itself as an asset class has its own allure, but ultimately it has to be matched with bottom up stories about gold production. I mean, gold production it's a tough business to be in, quite frankly. Mining tons of rock to generate grams of gold, and doing that at scale and consistently it's a tough business, and lots of companies don't do it well. And we've seen, broadly speaking, we've seen a very significant derating of gold equities over the last decade, I think reflecting the reality of how difficult it is. So the two names that we have built exposure to, Newcrest here in Australia, which has the attraction of having one of the most attractive reserve profiles of anyone in the industry. Its reserves go out more than 25 years, and it has some of the lowest cost mines in the world, and more to come on stream in the second half of this decade, which will, I think, according to our analysis, will allow them to dramatically reduce their all-in sustaining costs and drive cash margins. And that's complemented by a position also in Barrick Gold, which is traded in Canada and North America. Again, a company that we think has a very high-quality asset base, where over the last number of years, the company has taken strong steps to address its cost structure. And we are now seeing the fruits of that effort coming through in their numbers. Both stocks are cheap, we think, on current spot prices, and there's certainly a case that gold prices can be much higher as we come to understand the persistence of inflation and where it is today. But you're able to buy these stocks on low double-digit multiples of free cash flow, so 10 to 12 times current spot rates, which we think is in a world of expensive stock markets is actually quite attractive.
Look, thanks for your time today, Graham. With energy and commodities in the spotlight, it's really been great to have you unpack both the shorter term and the longer term issues. For more information on Antipodes or our views, please head to our website antipodes.com or follow us on LinkedIn or Twitter. Remember to subscribe to this podcast wherever you're listening so you get an alert as soon as our next episode goes live in a few weeks.
Please remember this content is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions.